Many traders drown their charts in dozens of indicators, spending hours trying to predict market movements. But if you strip all of that away, you will find a much simpler approach. You can build a highly profitable, purely mechanical trading system by analyzing the price action of just one specific daily candle. By the end of this breakdown, you will have a strict 3-step checklist to execute this strategy across crypto, Forex, and gold markets. To run this system, you only need clean charting software, like TradingView, and the discipline to follow a few rigid rules. Removing subjective indicators and relying purely on fixed daily price boundaries gives you a repeatable, emotionless edge in the market. Step 1 is establishing our daily framework. Open the chart for the asset you want to trade and set the time frame to 4 hours. Look down at the bottom right of your screen. You must change your chart's internal clock specifically to New York time to align with the start of daily market volume. Next, locate the very first 4-hour candle that forms at the exact start of the current trading day. Before you do anything else, you must wait for this specific 4-hour candle to fully complete its time cycle and close. Once that candle closes, draw a horizontal line at its exact peak and another at its exact valley. Project both of these lines forward to the end of the day. These 2 lines are now your definitive structural boundaries. They dictate every trading decision you make for the rest of the session. With the boundaries set, we drop the time frame all the way down from 4 hours to the 5-minute chart. On this lower time frame, your only objective is to watch exactly how the price interacts with the high and low lines we just drew. Here is the first half of our trigger mechanism. A 5-minute candle has to push completely outside of the boundary line. Watch the candle body closely. A wick piercing the line does not count. The solid body of the 5-minute candle must fully close outside the boundary. Once we get that close outside, we wait for the second half of the trigger. A subsequent 5-minute candle must reverse direction and close firmly back inside our original boundary. This specific out and back sequence signals that the initial move was likely a liquidity trap, providing the high probability environment needed for an entry. This trigger translates into simple binary action. Breaking the top line and returning signals a short entry. Breaking the bottom line and returning signals a long entry. For a short entry like this, you cap your downside by placing a stop loss at the absolute extreme peak of the false breakout move. Then you set your take profit target to be strictly twice the visual size of that stop loss. This exact 1-to-2 risk-to-reward ratio is strictly non-negotiable. It is the mathematical foundation that keeps the strategy profitable. By rigidly defining your exact failure point and your success point before you enter the trade, you eliminate mid-trade panic and emotional sabotage. Occasionally, the market will throw an extreme anomaly at you. The false breakout will be a massive, violent spike, snapping right back into the range. Placing your stop loss at the extreme end of a massive spike makes your mathematical risk zone far too large to trade safely. When this happens, we use a specific key level exception to adjust our risk. Instead of using the extreme distant wick, look backward on the chart. Find a closer cluster of support or resistance, like a recent order block, and hide your stop loss behind that structure instead. With your stop loss tightened, your take profit must still be strictly calculated at precisely 2 times this new, smaller risk amount. Adapting the stop loss to structural market levels instead of blindly following an extreme anomaly protects your capital from unnecessary exposure. Let's move from the mechanics to historical data, seeing how this system performs across different markets. On the Bitcoin 5-minute chart, 7 trades resulted in 5 wins, yielding a 72. Open your charting software right now. Locate yesterday's price action and manually backtest this framework yourself. A true trading edge doesn't come from predicting the future, but from the disciplined application of a proven mechanical sequence day after day.